So based on the course outline, the next thing we are going to talk about this morning is the measurement of economic activity. Now, this topic is also quite important because to understand the dynamics of every economy, we need to measure the amount of activity going on. For instance, we normally hear in these radio discussions or TV debates that the size of Ghanaian economy is bigger than the size of another economy, or they can say the size of another economy is bigger than the size of Ghana's economy, right? We normally hear these things. Now, for us to compare the sizes of economies, or for you to even say that the size of your economy has grown, right? For you to even say that, the size of your economy has grown, what it means is that we need to find a way to measure the amount of economic activity going on, because if we're able to measure the amount of economic activity going on, we can simply know the size of your economy, right? So by the end of this class, this particular topic, we should be able to know how economists define and measure an economy's output or economic activity. You should be able to know the uses of this measurement. What do we use it for? So if you're able to measure the amount of economic activity going on in our economy, what do we use those things for? You will know it. Then we would also learn the problems associated with measuring the amount of economic activity going on in an economy. We will know the problems that we encounter when we want to measure it. Then we would also learn the difference between real GDP and nominal GDP. Then we also discuss other factors of economic activity that should be monitored in addition to the standard ones, right? Now, to measure the amount of economic activity going on, right? Or to account for the amount of economic activity going on, we have several approaches to do that. But first of all, let's ask ourselves, what is economic activity? It is simply the level of production of goods and services over a particular time period, usually measured quarterly or annually. But of course, in Ghana, we measure ours annually. All right. So in simple terms, before we even get to the measurement, I want you to know that when we refer to economic activity, we mean the level or the amount of goods and services produced in an economy over a period of time. This means that anytime there are changes every year, it represents growth, because if we produce goods worth, let's say, $5 million in a year, and the following year we produce goods worth $6 million, it means that there have been a growth in our production. That actually signifies economic growth. On the other hand, if rather there is a reduction, it represents a negative growth. So normally we hear in this debate, our economy has grown by 10%, it has grown by 5%. These are the ways we get to know that our economy has grown. Now, how do we measure the economic activity in an economy? Or how do we account for the economic activities going on in an economy, right? Now, one of the simple ways to account for the level of economic activities going on in an economy is to look at the market value of all final goods and services produced by an economy over a specified period of time. So let me explain that. Why we even use the word final goods and services. Why do we use final goods and services? We use the word final goods and services because we want to actually avoid the problem of double counting, right? We want to actually avoid the problem of double counting. That's why we use the phrase final goods and services. All right. So let me give an for instance, if a company produces flour, like flour, the flour that we use to bake bread, okay? So if a company produces flour that we use to bake bread, then the bakery goes to buy the flour from the company and also uses the flour to produce bread and sell the bread. If we measure economic activity by the total market value of the bread as well as the value of the flour, we would have done double counting. Double counting in the sense that, remember, the flour was used to produce the bread. So once we sell bread at, let's say, 10 cedis, the bread technically includes the value of the flour, because for somebody to sell bread at 10 cedis, the person would have, taken into consideration the value of the flour that he or she used to produce the bread. That is why we want to look at the total market value of all final. As I said, final means that we don't consider intermediate goods or goods that are used in further production. We don't consider them because they'll be counted in their last stage, like the example I was giving. So the total market value here that we are referring to is the entire monetary value, that's in the money, the monetary value of the goods and services, right? Let's look at this. This is a very simple example here. In an imaginary economy, total production is 4 apples, 6 bananas, and 3 pairs of shoes. All right, so 4 apples, 6 bananas, and 3 pairs of shoes. So 4 apples, 6 bananas, so let's say 4 apples, 6 banana, and then 3 pairs of shoes. Then the question says that, suppose that we know that apple sells for 2 cedis. So 4 apples at 2 cedis each. And then banana sells for 50 pesos. So 6 bananas at 50 pesos each. And then shoes sells for 100 cedis. So 3 pairs of shoes at 100 cedis. What is the market value of this economy's production, or its GDP? So 4 times 2 give us 8 Ghana cedis. 6 times 50 pesos will give us 3 Ghana cedis. And then 3 shoes at 100 cedis each will give us 300 cedis each. So in total, we have 311 Ghana cedis. All right. So I'm just giving you an idea as to how our GDP is calculated. Of course, in the bigger economy, it's not only about apples, bananas, and shoes. It goes beyond that. But those things are calculated by statistical service and all those, Ministry of Finance and all that. So let's not get into the bigger picture. They do those calculations, but I want you to have a fair idea that is how GDP is calculated, right? We just find the market value of our goods and services and then we sum them up. So that is how GDP is calculated. Now, if you want to calculate GDP, or if you want to account for GDP, there are 3 methods that we can use. And all the 3 methods should give you the same answer. it should give you the same answer. So if you want to calculate GDP, there are three methods that we use. And I'm saying that those three methods should ideally give you the same answer. All right. So that's why we call them national income accounting methods. National income accounting does not mean that we are doing like financial accounting, but it means that they are methods that we use to account for GDP. So we have the output method. We have the production method, which is the same. Sorry, we have the output or the production method. We have the income method, and we have the expenditure method. So three methods, right? Output, income, expenditure. Output, income, and expenditure. Now, all of these three methods technically should give us the same answer. All of these three methods technically should give us the same answer. Because think about it carefully. If you produce goods and services worth 311 Ghana cedis, that's the output method, right? That's 311 Ghana cedis, right? Those goods and services will be bought by people. So that brings us to the expenditure method. Okay, so because those 311 Ghana cedis worth of goods will be goods that people spend their money on. So that's how the output method is equal to the expenditure method. And then if firms sell goods and services, they pay income to the people who provided they pay income to the people who provided the resources to produce goods and services, right? So, like for instance, they will pay their employees who sold the goods, they will pay their employees who manufactured the goods and services, right? So they also pay profits to the firm itself and all that. So that is how come these three methods should be the same. The output method should be equal to the expenditure method and should be equal to the income method. So let's get into them in detail. So let's start with the output method. Now, this method calculates the value of the final, look at the word, the value of the final output of goods and services produced in an economy over a specified period of time. All right, giving rise to the concept gross domestic product, GDP. So anytime we are calculating the total value of the final output of goods and services in an economy, we call it GDP. Now, another keyword I want you to pay attention to here is this, right? Another keyword I want you to pay attention to. It says gross domestic product. So the keyword I want you to pay attention to here is the domestic. Domestic means that they are goods and services produced within Ghana. That's the meaning of domestic, right? So for instance, if those goods and services are produced by even foreigners that are in Ghana, we count it as part of GDP. But if the goods are produced by Ghanaians that are abroad, let's say a Ghanaian is producing something in US, that production done by the Ghanaian in US, we don't add it to GDP. Why? Because the key word is domestic. So anything produced within the boundaries of Ghana, it counts as GDP, gross domestic product. So even if they are produced by foreigners who are living in Ghana here, we still count it as part of what? GDP, gross domestic product. Now, remember that I told you that when we are calculating GDP, we need to avoid the problem of double counting. It's important. Remember that. I think I mentioned it earlier. We have to try and avoid the problem of double counting, where we count goods and services twice, especially if the goods are components of another goods and services. Okay, so where we count it twice, right? Where we count it twice, it's not a good thing. Okay, so like for instance, we count the value of flour, a bag of flour. Let's say, I don't know the price. Let's assume maybe 200 or 300. Let's assume. Now, if those flour are used in the production of bread, and we sell the bread for 500 cedis, that's in all the pieces of bread, and we count the flour as 300, bread as 500, you get 800. And we are double counting because the bread of 500, no, the flour of 300 is already included in it. Okay, so always, as I said, to avoid the problem of double counting, we need to take out intermediate goods. All right. Or we can only sum up the value added at each firm at the different stages of production rather than the final output. So let me explain that. So those who produce the flour, it was worth 300. So you can write 300 down as production of flour. Then those who added value to the flour to make a bread to sell at 500 cedis, their value added will not be the whole 500 cedis, but the difference between 300 and 500. So that's also another approach. So one approach is that you can just look at the final goods and services, simple. Another approach is that you can look at what? Value added at each stage. So stage one is production of flour, 300 cedis. Stage 2, value added by bread producers will be extra 200. So that finally we get what? The 500. All right. So you can go the value added approach, or you can go the final goods and services approach. You should get the same answer. All these things are aimed at avoiding double counting. So as I said, if you want to compute the total output of an economy, as I said, you can go the final output approach, or you can do the value added approach. Two approaches: the final output approach or the value added approach. Let's look at this example. As for the final output approach, there are no examples in this slide because then it's very obvious. Okay, it's very obvious. So let me show you something. Consider a situation where firm A supplies components valued at 10 million cedis to firm B, which in turn sells its output valued at 14 million to firm C. Then firm C will sell it at 17 million to the final consumer. What is the total output for the economy? Now, here, if I'm not using the value added approach and I want to find GDP is simply 17 million. Simple. Because that's the final value sold to the final consumer. So GDP would have been 17 million. But if I want to use the value added approach, I have to look at the value added at each stage of production. So for instance, I can look at value added by firm A. So firm A produced the component and sold it to firm B at 10 million. So firm A, his value added was from 0 to 10 million because there was nothing. And they produced something 10 million and sold to firm B. So the value added by firm A is actually 10 million. Now, the value added, so here, the question says that firm B in turn sells the output at 14 million to firm C, right? So here, we can say value added by firm B. Remember, firm B bought something at 10 million. They manufactured something out of it and sold it at 14 million. So it means that the value added by firm B is actually only 4 million. Oh, my Ghana cedi sign, sorry. So only 4 million. Then firm C also took that 14 million and sold it at 17 million to the final consumer. So value added by firm C is that they had 14 million. They manufactured something and sold it at 17 million. So they have only added a value of 3 million because 14 to 17 is 3 million. So in total, our final GDP will be what? 17 million. That's 10 plus 4 plus 3. So our total GDP will be 14 million. 10 plus 4 plus 3. That would be, sorry, 10 plus 4 plus 3 is 17 million, sorry. So 10 plus 4 plus 3 is 17 million. Of course, somebody is wondering, why is it that we just don't take the final one as the answer? Yeah, that's what I said, that there are two approaches, right? The value-added approach and then the final output, the final goods and services approach. The reason why we do the value-added approach is that we want you to know that is how we got it. Like that, those are the stages of production that made us get it. All right. So that is the reason why. Okay, that's the reason why it is like that. Now, let's take another example. Your barber charges 10 cedis for a haircut. In turn, the barber pays his assistant 2 Ghana cedis in return for sharpening scissors, sweeping the floor, and other chores. For each haircut given, what is the total contribution of the barber and his assistant taken together to GDP? This is very simple, right? So the assistant of the barber, right? So value added by assistant is 2 cedis. Why is it 2 cedis? It's 2 cedis because when they do a haircut to the final consumer, they charge 10 cedis. But how did we get there? How we got there was that the barber's assistant will get 2 cedis because he sharpened the scissors, he swept the floor, he did all the other chores before the barber cuts the hair. Okay, so his value added is the 2 cedis. Then the value added by the barber himself is the 8 cedis. So in total, we have 10 cedis. The value added by the barber himself, it's 8 cedis. So in total, we are going to have 10 cedis in total, right? So the 10 cedis was what was charged to the final consumer. But out of the 10 cedis, the barber's own is the 8 cedis. Then his assistant's own is the 2 cedis. So in total, we have 10 Ghana cedis. So the examples can go on and on and on. But all I want you to know is that in calculating GDP, this way is the best in my view because you will know everybody's contribution to GDP at a point in time, right? So you know, and as I said, I'm going to give you some questions for you to practice later. So there are more examples, more examples. Consider a situation in which a firm produces 50 pesos worth of grain with no input from other firms. Firm B uses the 50 pesos worth of grain from firm A to produce 1 cedi 20 pesos. And finally, firm C buys 1 cedi 20 pesos flour from firm B and uses it to produce 2 cedis worth of bread, right? So this is also obvious. This is very, very obvious. So here to value added by firm, so value added by firm A was the 50 pesos. Value added by firm B, who got the 50 pesos and 1 cedi 20 pesos. So he added 70 pesos, the difference. Then value added by firm C, who got the 1 cedi 20 pesos and did 2 cedis. So his is 80 pesos. So in total, we are going to have 2 cedis. All right, so the examples can go on and on and on and on. All right, but then the idea is that we sum it up at every stage of production. Now let's look at the income method. The income method. Income method. Now, how do we know the income method? So the income method says that we must look at income that is paid to all factors of production, right? Now let's think about this. If you have a business, right? Which people are the people who provide the resources for you to operate the business? One obvious people in a business that provide their resources to operate a business is your employees. Your employees, they provide a resource called labor. All right, so our employees, they provide a resource called labor. Okay, so we have to pay them. So when we produce goods and services, and when you sell the goods and services, the money that you get, one of them will go to the labor. Labor means the people who, like all of us are, all workers in Ghana are actually laborers. We are part of labor force. So the people that produce the goods and services, we have to pay them labor income, like wages, salaries, and incomes of self-employed people. So wages, salaries, and incomes of self-employed people. So wages, salaries, and incomes of self-employed people. Now, what other people or what other category of people would receive income when we sell goods and services? So another category of people that receive income when we sell goods and services are those who provided capital for the business. So for instance, if somebody provides his factory, or if somebody provides his building to you to do a business, you pay rents to him. So rent is part of factor incomes. Rent. So if anybody if anybody gives you labor, you pay wages and salaries. If anybody gives you building, you have to pay rent. So I'm talking about wages. Oh, I'm talking about wages and salaries. I'm talking about rent. Now, if somebody provides you with loan as a resource, you have to pay interest. Interest on the loan. If somebody gives you their land to mine, you have to pay them royalties. Or if somebody even gives you intangible assets. When we talk about intangible assets, like somebody's copyright, patent rights, like now, like if you those of you who are into music, they say that when you sample somebody's music, you have to pay the person royalties. Because music is that person's resource. Then you have gone to copy part of his music, you have to pay royalties. Now, if I'm an entrepreneur, all right, if I'm an entrepreneur, what do I get from me managing a business? I'm going to get profit. I'm going to get profit from managing a business. I'm going to get profit. So, what I want you to know is that when we pay monies to all these factors for production in the form of wages and salary, rent, interest, royalties, profits, etc., when we sum all these factor incomes together, it should give us the same answer as the output method. It should give us the same answer as the output method, right? And one of the things I want you to know is that all the incomes are always measured prior to payment of tax. So all the incomes, it's not your net. You are looking at gross, all right? Because tax income is also an income to the government. And all that. But we want to avoid those things in the calculations. That's why I'm saying that all the incomes are measured prior to the payment of tax. Now, one major thing that we must exclude from the income approach is transfer payment. Transfer payment. Now, what is transfer payment? I think the very first meeting I mentioned what transfer payment is. I remember I told you that transfer payment is payment for which there is no goods and services received in return. So anytime you make payment and you don't receive any goods and services in return, you have done transfer payment. So anytime you receive payment, right? So anytime you make payment, without receiving any goods and services in return, you have actually done transfer payment. Now, the issue here is why is it that we don't count it as part of the income method? We don't count it because it's just a mere redistribution of income. Let me explain that. So for instance, you are a worker. You receive wages and salaries at the end of the month, right? Then you have a child who is in senior high school. So you remit some of the money to your child at the senior high school. Now, when you give your child money, you are not receiving, it's not like you bought goods or services from him. No. You are virtually dashing him the money. And it's called transfer payment because anytime you make payment without receiving any goods and services, it's actually transfer payment. Or in a simple plain language, anytime you dash somebody money, you have made transfer payment, actually. Now, if your salary was, let's say, 5,000, and no, you give your ward 500 cedis, and they capture your salary as part of the income method, 5,000, and they add the salary of your ward, 500. It's a mistake because then it will seem like you alone, your salary was 5,500, and that is not the case. So anytime you are doing the income method, remember that you have to exclude transfer payment. Why? Because transfer payment is simply a redistribution of income. Right? It's not like income that you receive because you are providing goods and services to somebody. No. Anytime you receive income, that is free money. In essence, we don't have to add it to the income approach because that free money that you received, it is part of somebody's income that he has worked for. He has provided goods and services for. All right. So that's why when we are doing the income method, we have to exclude transfer payment. Finally, the expenditure method. The expenditure method. Now, what goes into the expenditure method? So the expenditure method, this can be done by adding up all the money values of expenditures on final goods and services. So here, what we mean is that all the spending made on final goods and services goes into the expenditure method. So what are the specific constituents? So we have expenditure made by consumers. And that expenditure is called consumption expenditure. We also have expenditure made by firms. Normally, we call this investment expenditure. And we have expenditure made by government. So we call this government expenditure. Now, we also have expenditure that we Ghanaians, we make on the goods and services produced by outsiders. That expenditure, we call it import. Import, right? Anytime we spend on goods and services produced by people in a foreign country, the only way we can spend on goods and services produced outside Ghana is when we import it. So the expenditure that we make on goods and services produced by people outside Ghana, we call it import. Now, that expenditure, we have to take it out. Why? Because that expenditure, it doesn't concern domestically produced goods. So anytime we have import, we have to take it out because import is not domestically produced goods. However, our exports are goods produced within Ghana, but then outsiders spend their money on it. So as for export, we have to add it because they are goods that were produced in Ghana, just that they were bought by outsiders. So finally, we add something we call net export. And net export is export minus import. In economics, macro, we signify export by X, and import by M. So in Ghana, in economics, macroeconomics, export, we signify it by X, and then we signify import by M. Okay. So that's how come the expenditure method, we have C plus I plus J plus XN. The XN here represents net export. The XM represents net export. Then again, to avoid double counting, only expenditure on final goods and services should be included. Now, let's get into them in detail. So what is consumption expenditure? I mean, I've given you the overview, but let's get into them in a little bit of detail, right? So what is consumption expenditure? It is simply expenditure made by consumers. So it is what, so here we say it is what household, when we say household, we mean consumers. It is what households buy, except houses. So it is what households buy, except houses. And the reason is that, the reason why we exclude it is that, you see, we exclude houses, buying of house as a consumption expenditure is that houses are actually goods and services produced by firms that are into real estate. All right. So we would want to actually classify houses and investment expenditure made by firms rather than expenditure made by household, right? So when you talk about consumption expenditure, we don't have to include houses because houses will better fit under investment expenditure by firms because people who are into real estate, they invest in houses. Okay. Then when you put houses aside, consumers can buy durables like car, appliances. Consumers can also buy non-durables like clothing, food, etc. So whether a good is durable, as in a good that takes long, car and those things, or non-durable, either ways, we add it to consumption expenditure. But just to know, the most prevalent consumption expenditure is usually the non-durable ones. The one that we buy and then we don't expect it to last more than a year. Like your haircut, paying for haircut, taxi, boat, paying school fees, buying air tickets or airline tickets, etc. Buying shirt, clothes, food. All these things are non-durables. But I'm saying that whether durable or non-durable, the idea here is that consumption expenditure should include expenses made by consumers, except houses, right? Okay. We also have investment expenditure. Now, what is investment expenditure? As I said, mostly investment expenditure are expenditure made by firms, not individuals, right? So it is made up of, number one, new construction of homes and apartments. New construction of homes and apartments. Number two, new capital goods. All right, so when we buy machines, when firms, they buy machine equipment, office building, office items, it's called investment expenditure. Then changes in inventory. So when you are a firm, and let's say at the end of the year, your stock of goods or your inventory of goods is 5,000. So listen carefully. When you end the year, your goods, your inventory or your stock of goods is, let's say, 5,000 cedis. The following year, your stock of goods that you ended with was 7,000. What that means is that you have added to your inventory, you have invested in your stock. Because this year I ended the stock with 5,000. Next year, my stock at the end of the year was 7,000. It means I've made an extra 2,000 cedis investment in my inventory. Here too, we want to exclude investment made by government and investment made outside the country. All right. And of course, any investment made by government, we better classify it under government expenditure. Because remember, there's expenditure, we have consumption, we have investment, we have government expenditure. We also have new construction in form of new buildings, be it for rental purpose or for residential purpose. All right, and then changes in inventory, which I've already, spoken about. So the G component, what is it? The G component. The G component is government expenditure or government purchases. So here, it combines all goods and services bought by all forms of government, from paper clips to bridges to hospitals. So any expenditure made by all forms of government, when we say all forms of government, we mean from ministries, from municipals, metropolitans, district assemblies, regional coordinating councils, like when we say all forms, so any arm of government, right? Judiciary, legislature, parliament, and all that. Every expenditure made by all forms of government, we call it government expenditure. And of course, remember, this does not include transfer payments. All right, like free senior high school is a transfer payment, paying for people's school fees. So we don't capture that as government expenditure because government does not receive any goods and services in return. They just dash money. Now, the last one is our net export. So our net export is the difference between export and import of goods and services. And remember, I've already explained to you that exports are actually goods produced in Ghana, but patronized by outsiders. So we have to add it. And then imports are goods that are not produced in Ghana, but it is bought by Ghanaians. So we have to take it out, right? So that's why we have net export represents the difference between total export and import. Expenditure method. So let's look at this example here, right? Let's look at this example here. Now, an economy produces 1 million cars, right? Valued at 15 Ghana cedis each. Of these 1 million cars, 700,000 cars are sold to consumers. 200,000 are sold to businesses. 50,000 are sold to government. 25,000 are sold abroad. No cars are imported. The cars left unsold at the end of the day are held in inventory by the car producers. What is the GDP using the expenditure method? So let's start with consumption. Goods and services bought by consumers. So they bought 700,000 cars, and each car is 15,000 cedis. Now, businesses, which represent the investment expenditure. So the businesses bought 200,000 cars, right? And of course, the price of the car is 15,000. But remember, when we were talking about investment, we also said that any goods and services that is left as inventory or stock at the end of the year is also part of investment expenditure. I remember I said it. Goods and services. So here, it includes inventory. So look at something here. 1 million cars, right? We sold 700,000. We sold 700,000 plus 200,000. That is 900,000. Plus 50,000. That is 950,000. Plus 25,000. That's 975,000. So we sold 975,000 cars. It means that 25,000 cars are left, which is inventory. And I'm saying that inventory is part of investment expenditure. So the 25,000 cars is also part of investment expenditure, which is inventory. Now let's go to government expenditure. For government expenditure, the question says that 50,000 cars were sold to government. So 50,000 cars times 15,000 cedis. Then finally, 25,000 cars were sold abroad. So that's export. Now there is no import, otherwise we would have subtracted, but it's just export. We don't have any import. So 25,000 cars were sold abroad. So the reason why we just use the export is that there is no import. Okay. So let's do some calculations here. Now, 700,000 times 15,000. Please, okay, so we have, the zeros are menu. So we have 1, 0, 5, 1, 2. You know what? Let's just take off 3 zeros, okay? Just for, otherwise the zeros will be many. So please, all the figures I'm going to give, I'm going to take off 3 zeros, okay? It doesn't mean that in an exam station, take off 3 zeros. It's because of the space. So I'm going to put the 3 zeros on top here. So 0, 0, 0. So it means that every figure you see has extra 3 zeros, okay? So we have 1, 0, 5, 0, 0, 0, 0, 0. Then the next one is 200,000 times 15,000. That is 3 million. Then 25,000 times 15,000, that's 375,000. Uh, then 50,000 times 15, that's 750,000. And then so the total will be 15 million. Or 15 billion if it has all the three zeros, right? Please remember that these two were investment expenditure, these two. Because the first one was firm's purchases, the second one was inventory. So everything will sum up to 15 million. If we were to use the output approach, it would have been simpler. The output approach would just be 1 million cars times 15,000. Again, if I take off the three zeros, you just get the 15 million direct. This is the output approach. Simple. But the expenditure approach will help you know the different constituents, like who bought what of the output. Okay, so that's the advantage of the expenditure approach. It will let you know who bought what at the end of the day. So that is the advantage of the output approach. Sorry, the expenditure method, right? That's the advantage of the expenditure method. Okay. So in essence, we have been able to go through how we calculate GDP using the output method, the expenditure method, and then the income method. So you have gone through these three approaches: output, expenditure, and income.